The financial war of the 21st century did not begin with soldiers, tanks, or missiles. It began quietly, inside a controlled conference room, with a prepared statement and one carefully placed sentence. On January 15, 2026, at exactly 9:37 in the morning Beijing time, the People's Bank of China held a short press conference. It lasted just under 12 minutes. There was no drama, no urgency, no warning signs. Domestic financial journalists filled the front rows. A small group of foreign correspondents stood at the back. 3 cameras streamed the event live to state media. The deputy governor stepped to the podium, adjusted his glasses, and read from a script. Most of the statement sounded routine. Updates on foreign exchange reserves, minor comments on monetary policy, language so ordinary that markets barely reacted. Then came a single sentence buried in the 3rd paragraph. China announced that foreign central banks and sovereign wealth funds would be offered the option to store their gold reserves inside newly constructed vaults in Shanghai, with settlement in renminbi, full insurance coverage, independent auditing, and guaranteed repatriation, all matching London bullion standards. With that sentence, China did not threaten the United States dollar. It did something far more dangerous. It created a working alternative. For 80 years, the dollar has dominated global finance, not because it was flawless, but because no rival had the infrastructure, liquidity, and trust needed to replace it. Gold was stored in London and New York. Trade settled in dollars. Reserves flowed through Western systems by default. China just ended that default. Within 48 hours of the announcement, 3 countries quietly responded. Kazakhstan, Saudi Arabia, Indonesia, all opened preliminary discussions with the People's Bank of China about transferring portions of their gold reserves to Shanghai. The combined gold under early discussion totaled roughly 840 million ounces. That amount alone rivals the gold stored in Western vaults. This was not a press stunt. This was operational capability. China had been preparing for this moment for years. Beneath the Pudong district of Shanghai, 6 massive underground vaults had been constructed in silence. Each vault can store roughly 500 million ounces of gold. Total capacity reaches 3 billion ounces. To understand the scale, consider this. All London bullion market vaults combined hold under 1 billion ounces. Federal Reserve vaults in New York hold far less. China built a system capable of storing more gold than both centers combined. And they did not build it for domestic use. They built it for the world. The vaults operate under a legal structure modeled after Swiss standards. Gold is stored on an allocated basis. Every bar is individually identified, physically segregated, and legally owned by the depositor. The gold cannot be lent, leased, or reused without written consent. This removes the hidden risks present in unallocated Western systems, where ownership is often blurred. Each depositor receives insurance coverage up to $50 billion. The policy covers theft, loss, damage, and sovereign seizure. That last protection matters more than most people realize. In 2022, Western governments froze hundreds of billions in Russian reserves. That event shattered a long-held assumption. Assets held in Western jurisdictions are not politically neutral. Central banks took notice. Trust fractured. China stepped into the gap. Independent audits are available on demand, conducted by international firms with physical bar verification. Repatriation is guaranteed within 90 days to any destination worldwide, fully insured and unrestricted. Compare that to the Federal Reserve, which once took years to return Germany's gold. Technically, China's system is stronger, but storage is not the real weapon. Settlement is. China requires vault fees, swaps, and gold-related transactions to be settled in renminbi. Gold-backed credit lines. Renminbi-denominated swaps. Trade settlement without dollars. This creates a parallel financial ecosystem where central banks can operate outside the dollar system entirely. The dollar's dominance rests on one pillar above all others. Network effect. Everyone uses it, so everyone must use it. Once that network fractures, dominance fades quickly. China did not fire a shot. It opened a door, and the world has already started walking through it. The speed at which the first responses appeared shocked many observers. This was not a slow diplomatic process. It was a calculated move by countries that had been watching the global financial system crack for years. The Shanghai Vault announcement simply gave them a safe exit. Gold is not just a metal. In global finance, it is trust in physical form. For decades, most of that trust was stored in Western vaults. London and New York became the default locations, not because they were safer, but because there was no alternative infrastructure capable of handling sovereign scale reserves. China changed that equation overnight. Behind the announcement stood a deeper strategy that had been unfolding quietly for more than a decade. China had been accumulating gold year after year, carefully and without attracting attention. Official figures reported steady increases, but history suggested those numbers told only part of the story. At the end of 2025, China officially reported roughly 74 million ounces of gold in its reserves. That number alone placed it among the world's top holders. But industry analysts widely believe the real total is far higher. When gold held by state-owned enterprises, sovereign funds, and undisclosed purchases is included, estimates range between 180 and 220 million ounces. This pattern is not new. In 2009, China shocked markets by revealing that its gold reserves were double what had been reported for years. The accumulation had happened quietly. The disclosure came only when it no longer mattered. Many analysts believe the same approach is being used again, and official reserves are only one layer. Chinese citizens are among the world's largest buyers of physical gold. Jewelry, bars, and coins are deeply rooted in cultural and financial habits. In recent years, private demand has averaged hundreds of tons annually. Over a decade, private holdings likely exceed 300 million ounces. When official reserves, undisclosed state holdings, and private ownership are combined, China's total gold exposure likely surpasses that of the United States. And unlike Western nations, much of that gold is not encumbered by leasing or lending arrangements. This matters because gold is not being accumulated as a passive store of value. It is being positioned as the foundation of a new monetary system. The renminbi currently accounts for a small but growing share of global payments. Around 5% by late 2025. That figure sounds minor until placed in context. The dollar dominates at just over 50%. The euro follows near 20%. 5% already places the renminbi ahead of several long-established currencies. But China does not need to replace the dollar outright. It only needs to weaken it. The strategy is not a formal gold standard. China is not fixing the renminbi to gold at a set price. That would limit policy flexibility. Instead, it is offering something subtler and more powerful: operational convertibility. Central banks holding renminbi know that those balances can be exchanged for physical gold through Shanghai at market prices. No promise, no fixed rate, just a working mechanism. That alone changes perception. When reserve managers compare holding dollars backed by a heavily indebted government versus holding renminbi that can be turned into audited, insured gold, the calculation shifts. Gradually at first, then all at once. The data already shows this shift underway. According to international reserve statistics, the dollar's share of global reserves has been falling steadily, from over 60% in 2020 to the mid-50 range by 2025. The pace of decline has accelerated. Once the share drops below 50%, the psychological threshold breaks. At that point, the dollar is no longer the anchor. It becomes one option among several. History shows that reserve currency transitions do not happen smoothly. They accelerate after tipping points. Confidence moves faster than policy. China's gold infrastructure provides the missing piece that previous challengers lacked: a credible physical settlement layer that bypasses Western control. That is why central banks are paying attention. This is not about ideology, it is about risk management, and risk is being redefined in real time. As confidence in the dollar begins to fracture, the consequences unfold in a predictable sequence. Reserve currencies do not lose status overnight through declarations. They lose it through flows. Capital moves quietly at first, then all at once. And by the time the shift becomes visible, it is already too late to reverse. The privilege of issuing the global reserve currency gives the United States one enormous advantage: the ability to borrow cheaply and endlessly. Foreign governments, corporations, and investors hold dollars and dollar-denominated assets as savings. United States Treasury bonds function as the backbone of this system. Safety, liquidity, and scale keep demand constant. Today, foreigners hold roughly $33 trillion in American financial assets. That figure exceeds the entire annual output of the United States economy. This arrangement allows the government to run persistent deficits without immediate consequences. It is the hidden subsidy of reserve status. Remove that status, and the math turns brutal. As central banks begin diversifying reserves into gold and renminbi, dollar assets must be sold to fund those purchases. Even gradual selling creates pressure. Treasury prices fall, yields rise, the cost of borrowing increases across the economy. The United States currently carries roughly $36 trillion in federal debt. The average interest rate on that debt remains manageable only because global demand for treasuries remains strong. If yields rise from the current range towards 7, 8, or even 10%, interest costs explode. At 10%, annual interest payments alone reach $3.6 trillion. That single line item would consume more than half of the entire federal budget. No combination of tax increases or spending cuts can realistically cover that gap. The choice becomes unavoidable: default, austerity on a historic scale, or monetary expansion. History shows which option governments choose. Money printing begins not as stimulus, but as survival. Bonds are purchased. Liquidity is injected. Rates are suppressed artificially. The currency absorbs the damage. Inflation follows. At first, it appears manageable. Then it accelerates. Once inflation expectations break, they do not return easily. Prices rise faster than wages. Savings lose value. Fixed income assets become traps. This is how reserve currency decline transmits directly into daily life. A stock portfolio can rise in nominal terms while falling in real purchasing power. A bond paying 5% becomes a guaranteed loss when inflation reaches double digits. Cash becomes a wasting asset. Hard assets behave differently. Gold, silver, energy, and essential commodities adjust upward with currency debasement. Real estate can protect value, but only when owned without excessive leverage. Debt behaves inversely. Fixed-rate debt becomes cheaper to repay as the currency weakens. This is not theory, it is arithmetic. If inflation averages 20% for 3 years, purchasing power is cut nearly in half. A saver with $100,000 loses over 40% of real value without a market crash. A retirement account holding $1 million becomes $600,000 in real terms if the currency weakens by 40%. The loss is silent. It arrives through prices, not headlines. This is why reserve currency transitions create the largest wealth transfers in history. Savers pay the price. Debtors benefit. Those positioned in hard assets preserve purchasing power. Those trusting nominal returns do not. China understands this dynamic. By offering gold-backed settlement infrastructure, it accelerates diversification. Central banks act cautiously, but they act decisively when risk changes. No one wants to be last holding depreciating reserves. The shift does not require hostility toward the United States. It requires only self-interest. As gold moves into Shanghai vaults, trade increasingly settles outside the dollar system. Energy contracts, commodity flows, bilateral trade agreements denominated in renminbi or local currencies. Each agreement reduces dollar demand marginally. Marginal changes compound. Once markets sense that reserve status is weakening, private capital follows official flows. Hedge funds adjust. Corporations hedge currency exposure. Long-term investors rebalance. At that stage, central banks are no longer leading. They are reacting. The transition feeds on itself. This is why timelines compress rapidly. Years of gradual change followed by months of acceleration. Confidence, once lost, does not wait for policy responses. China did not need to announce a new order. It needed only to provide a credible exit. The rest unfolds automatically. As the shift accelerates, governments are forced to respond in real time, often with tools that no longer work. Central banks were built to manage cycles within a stable system. They were never designed to defend a currency losing its global role. When foreign demand for United States debt weakens, the Federal Reserve becomes the buyer of last resort. It steps in to stabilize bond markets, not to stimulate growth, but to prevent collapse. This distinction matters. Emergency buying sends a message that private demand has disappeared. Markets read that message clearly. Interest rates may be cut aggressively in an attempt to reduce pressure, but rate cuts in a weakening currency environment do the opposite of what is intended. They push investors away. Capital seeks stability. Yield without confidence is meaningless. Quantitative easing returns, not as policy, but as necessity. Each new round expands the money supply faster than the real economy can absorb it. Prices rise. Imported goods become more expensive. Energy costs surge. Food follows. Inflation stops being abstract and becomes personal. This is the point where public trust erodes. People do not measure inflation through statistics. They measure it at the grocery store, at the gas station, in rent payments. Once households realize that their money buys less every month, behavior changes. Spending accelerates, saving disappears, velocity increases, inflation feeds on itself. Governments attempt controls, price caps, subsidies, temporary relief programs. These measures treat symptoms, not causes. They increase deficits. More borrowing requires more printing. The cycle tightens. Meanwhile, countries that diversified early face fewer shocks. Those holding gold reserves outside Western systems retain optionality. Those settling trade in alternative currencies reduce exposure. Energy exporters benefit the most. They can choose settlement terms. Importers must accept them. This rebalances power quietly but decisively. For the average person, the consequences are uneven. Those with fixed salaries feel pressure immediately. Those with assets tied to inflation adapt more easily. Those with debt discover that repayment becomes easier in real terms. Those with savings discover the opposite. This asymmetry drives social tension. The middle class, built on savings and stable income, absorbs the largest hit. Wealth concentrates toward asset holders. Political polarization intensifies. Economic frustration seeks explanation and blame. These outcomes are not unique to any country. They appear in every reserve currency transition throughout history. What makes this moment different is speed. Technology accelerates capital movement. Information spreads instantly. Financial instruments allow repositioning in minutes, not months. The same tools that made the dollar dominant now work against it. China understood this acceleration. That is why the infrastructure was completed before the announcement. Once revealed, it was ready. No delays, no uncertainty. Operational on day one. This credibility mattered more than rhetoric. When Saudi Arabia and other energy producers begin settling portions of trade outside the dollar, the effect multiplies. Energy is the foundation of industrial economies. Price it differently, and everything downstream adjusts. The petrodollar system, built over decades, weakens through contract renegotiation, not confrontation. Each new agreement sets precedent. Each precedent becomes normalization. By the time markets realize what has changed, behavior has already shifted. This is how financial dominance ends, not with collapse first, but with alternatives becoming normal. Gold does not replace currencies. It anchors them. It restores discipline indirectly. When currencies can be exchanged for something tangible, excess becomes costly. China is not exporting ideology. It is exporting structure. For individuals, preparation is not about panic. It is about realism. Currency risk is no longer theoretical. Diversification is no longer optional. Exposure to a single system becomes vulnerability. Skills matter. Mobility matters. Ownership matters. History rewards those who adapt early and punishes those who assume permanence. The dollar will not disappear. It will remain important. But importance is not dominance. Losing dominance changes everything from interest rates to asset prices to global influence. This transition was years in the making. The announcement simply revealed it. The financial war did not begin in January 2026. That was only the moment it became visible, and once visible, it became unstoppable. As the global system adjusts, the question shifts from geopolitics to personal reality. Large institutions move first, but individuals feel the consequences most sharply. Currency transitions always arrive at street level eventually. They show up in prices, wages, loans, and life choices. When a currency loses dominance, it does not fail evenly. Some sectors benefit, others collapse. Exporters gain competitiveness. Importers pay more. Asset owners adapt faster than wage earners. This uneven distribution of pain reshapes societies. For households holding most of their wealth in cash or fixed income assets, inflation becomes the silent destroyer. The number in the account stays the same, but its meaning erodes. Each year of double-digit inflation removes purchasing power permanently. Compounding works in reverse. This is why financial literacy becomes survival skill rather than academic interest. Hard assets behave differently. Gold does not generate income, but it preserves value across currency regimes. Silver follows similar logic with greater volatility. Commodities reflect real-world demand. Energy, metals, and food respond directly to monetary expansion. Real estate can protect wealth, but only under specific conditions. Location matters, debt structure matters, fixed-rate loans become advantageous, variable rate debt becomes dangerous. Liquidity matters more than appreciation. Employment also shifts. Jobs tied to financial engineering and asset inflation struggle. Jobs tied to physical production, maintenance, and essential services gain resilience. Skills that cannot be outsourced or automated retain value regardless of currency. History favors those who produce tangible outcomes. For younger generations, the transition presents both risk and opportunity. Entry barriers fall when old systems destabilize. New trade routes, new settlement mechanisms, new financial hubs emerge. Those flexible enough to adapt early benefit disproportionately. This is how every major monetary shift reshuffles winners and losers. Governments attempt to manage expectations. Officials reassure. Forecasts soften language. But credibility weakens when lived experience contradicts messaging. Once trust erodes, communication loses power. At that stage, behavior replaces belief. People spend faster. Businesses shorten planning horizons. Contracts shorten. Long-term promises lose appeal. The economy becomes reactive. Volatility increases. Gold's role grows not because of nostalgia, but because it functions outside political systems. It does not require trust in promises. It exists independent of policy. That independence is its strength. China's strategy recognized this psychological reality. By anchoring settlement options to physical gold, it bypassed ideological resistance. Central banks do not need to believe in China. They only need to reduce risk. That reduction becomes justification enough. As more countries join the alternative system, exclusion becomes costlier than participation. Even allies face pressure. Neutrality becomes strategic. Alignment becomes fluid. Multipolar finance replaces hierarchy. This transition does not mean chaos. It means fragmentation. Multiple currencies, multiple settlement systems, multiple standards. Complexity increases, stability decreases temporarily. Eventually, a new balance forms. The previous system lasted because it was simple. One dominant currency, one primary settlement network, one trusted reserve asset. That simplicity is gone. The new era rewards adaptability. For individuals, the lesson is not fear, but positioning. Overconcentration in any single asset, currency, or jurisdiction becomes liability. Flexibility becomes asset. This does not require extreme behavior. It requires awareness, balanced exposure, understanding how inflation, debt, and currency interact. The financial war is not fought with weapons. It is fought with allocation decisions. Every portfolio choice, every saving strategy, every career move participates in the outcome. The battlefield is not distant. It is personal. Those who recognize the shift early do not need to predict every detail. They only need to accept that the rules are changing. And once rules change, standing still becomes the most dangerous position of all. As the transition unfolds, one mistake becomes common among both governments and individuals. They assume that change will be slow because it always has been before. This time is different. Speed is no longer limited by physical movement alone. Capital, information, and confidence move instantly. In previous reserve currency shifts, decades separated dominance and decline. Today, feedback loops are tighter. A policy decision in one country triggers market reaction worldwide within minutes. Central banks monitor each other continuously. When one acts, others respond. This creates compression. What might have taken 20 years in the past can now happen in 5. What might have taken 5 can happen in 1. Once momentum builds, restraint disappears. China's advantage lies not just in preparation, but in timing. The announcement came at a moment of extreme global debt, persistent inflation, and rising political fragmentation. Trust in institutions was already fragile. The system was ripe for an alternative. That alternative did not need to be perfect. It only needed to exist. Critics argue that China's system carries its own risks. Capital controls, political opacity, governance concerns. All of these are valid, but reserve management is not about loyalty or ideology. It is about minimizing exposure to catastrophic loss. After 2022, one risk moved to the top of the list: asset seizure. Once that line was crossed, reserve managers began searching for insulation. Gold stored outside Western control became attractive again. China provided a venue at scale. This does not mean trust shifts fully to China. It means dependence on the West decreases. That distinction matters. Reserve diversification rarely returns to concentration. Once assets move, they tend to stay distributed. Reversals require overwhelming incentive. In this case, incentives favor continued fragmentation. Markets adapt faster than politics. Financial institutions begin offering products aligned with the new reality. Trade finance denominated in multiple currencies. Hedging tools designed for inflation persistence. Asset allocation models that treat gold as core rather than peripheral. The language of finance changes. Risk-free rate becomes conditional. Safe haven becomes relative. Correlation assumptions break down. This forces a rethink at every level. Pension funds reassess long-term return assumptions. Insurance companies adjust liability models. Corporations rethink supply chains and pricing strategies. Governments revise borrowing expectations. Each adjustment reinforces the trend. Public narratives often lag these shifts. Official messaging emphasizes stability. Reassurance becomes frequent, but repetition weakens credibility when actions contradict words. People notice what institutions do, not what they say. As inflation reshapes behavior, social priorities change. Consumption patterns shift toward essentials. Luxury demand becomes volatile. Credit use rises initially, then contracts sharply as rates climb. Political pressure intensifies. Economic stress rarely remains economic. Throughout history, monetary instability precedes political change. This does not guarantee collapse, but it increases volatility. Policy errors become more costly. Mistiming becomes dangerous. In this environment, flexibility outperforms conviction. Those who cling to old assumptions struggle longest. Those who adapt incrementally preserve options. Extreme positions create fragility, balance creates endurance. Gold's renewed role is not ideological. It is functional. It provides a reference point outside policy cycles. It absorbs excess without requiring trust. It anchors expectations when currencies compete. This does not mean a return to the past. It means the past is informing the future. The emerging system will not crown a single winner. It will distribute power. That distribution reduces the dominance premium enjoyed by any one nation. Borrowing costs rise. Discipline returns indirectly. For the United States, this is adjustment, not disappearance. For the world, it is diversification, not alignment. For individuals, it is awareness, not panic. The most dangerous assumption is that tomorrow will resemble yesterday. The second most dangerous is believing change will announce itself loudly. Often, the most important shifts arrive quietly, disguised as technical adjustments. That is how this transition began. With a sentence, with vaults, with options, not with force. And once options exist, choice follows. Choice is what reshapes systems.